Welcome back. In this video, I'm going to talk about a summary on the valuing stock using dividend discount model. Now, this video is number 5 in a set of 5 videos. Looking at the basic principles of valuation, we can identify 3 building blocks. Building block number 1 is that you need to determine the expected future cash flows to the investors. Number 2 is that you need to determine the discount rate. And number 3 is that you need to identify the appropriate formula to calculate the present value of the cash flows using the discount rate. The 3 building blocks can also be identified as the valuation triad. Let's have a closer look at the definition of stock. Equity shares, or stock, are the main source of finance of a firm. It is issued to the general public, which we call investors or shareholders. Equity shareholders are entitled to the residual income of the company, and they enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of the company. From this perspective, shares of stock represent the ownership of portions of the future earnings potential of the firm. That's why we have no maturity date. And also, this is why projections of future performance can have a significant influence on daily stock trading prices. We have in this case 2 types of stock. Common stock is the term used to describe shares representing an equity stake in the firm. A common stock shareholder can only receive a share of annual profits, dividends, after all bondholders and preferred stockholders are paid. Preferred stock is the term used for shares that give their holders a higher claim on any profits or proceeds from asset sales, putting their shareholders ahead of common stockholders, but behind bondholders. So preferred stockholders gets paid before common stock. However, preferred stock in general does not have any voting rights. The primary market is where equity shares are created. We also call this an initial public offering, when a company for the first time is going to sell shares in the market. While in the secondary market, that is where the securities are traded by investors. And finally, we've seen in the previous slides that the dividend discount model provides the framework of valuing equity shares in the market. Let's have a look at the foundations of the dividend discount model with the following case. We have a company and it generates a net income of 100,000 euros. No growth, and the future profits are paid out entirely to the stockholders as dividend. We have 10,000 number of shares outstanding. The first dividend payment is exactly 1 year from today, and the cost of equity is 10%. What is the value of the stock? Now, as the payout ratio is 100%, so it means that the 100,000 euros of net income is going to be fully distributed as dividend to the shareholders. That means that we have an earnings per share, which is equivalent to the dividend per share of 10 euro. Now, when investors have the same beliefs about the dividend payment in the future, which means that they all expect that the size of dividends is going to be 10 euro until the infinity, and the cost of equity is 10%, then the stock price is trading for a price of 100 euro per share. Let's look at another example. Assume that the same company as in the previous slide has growth opportunities. In order to finance this growth, 50% of the profit is reinvested. So the reinvestment rate is 50%. The payout ratio is also 50%. What is the value of the stock when dividend growth is 8% per year? Well, we know that the earnings per share last year were €10. However, in this year, he's going to reinvest it in the business, earning 8%. So the earnings expected at the end of the first year are going to be €5.40. Then the cost of equity is 10%, the growth rate is 8%. That gives us a new stock price of €270. Let's have a look at multiple analysis, where we're going to have a look at the PE ratio for example 1 and example 2. PE stands for price of equity divided by net earnings. Well, in the first example, where the company does not reinvest anything, we are going to have a PE of 10. In the example where the company is going to reinvest money in the business, obviously with a positive NPV, the PE is going to be 27. So the difference is that in this case the company reinvests nothing, and here obviously the investors are willing to pay more for the same company if the company reinvests money in positive NPV projects. So let's have a look at another example using the same company. In this case, last year, the whole profit was paid out as dividend. As a result, the company is having growth opportunities not in the first year, but from year 2 onwards. That makes sense, huh? Because last year we didn't reinvest anything, so we can have no growth opportunities in the first year. As from the coming year, the payout ratio will be 40%. That means that 60% will be reinvested in the business at the end of the first year. The expected growth rate is going to be 6% per year after year 1, 2 and onwards. The question is, what is the current value of the stock and what's the value of growth? Let's have a look at the solutions. First, we need to establish the size of the dividend. The size of the dividend at the end of the year is going to be 4, which is 40% times the earnings per share of last year, which gives us €4. Why €4? Because in this year, we're not going to have any growth for the simple reason that last year, everything was paid out in terms of dividend to our shareholders. So in the first year, we will not include any growth. So using the DDM model, we have a dividend at the end of the first year, which is €4, cost of equity, which is 10%, a growth rate after year 1 of 6%, gives us a share price of €100. Now, what is the value of growth? I'm going to discuss that in the next slide. Let's answer the question, what is the value of growth? You can already see that our stock price is 100, which is equal to the stock price in the first example, that was also 100. So from that alone, you can conclude that the value of growth is absolutely 0. That's strange, no? The company is going to reinvest money in the business, but the value of growth is 0. The answer is in this equation. Because the growth rate is 6%, the reinvestment rate is 60%, so the return on investment has to be 10%. And this 10% is the return that the company is generating on its projects. However, it also needs to pay 10% to its equity capital holders. That means that on every euro they earn 10%, they need to pay 10%, So the NPV on their investment opportunities is absolutely zero. So we conclude that the value of growth can only be positive when the return on investment is greater than the cost of equity capital. Let's look at the valuation of a typical equity piece that is called preferred stock. Par value, what is that? The par value of a share of preferred stock is the amount upon which the associated dividend is calculated. Thus, if the par value of the stock is 1,000 euro and the dividend rate is 7%, then the issuing entity must pay 70 euro per year for as long as the preferred stock is outstanding. Well, the 70 euro over a cost of equity of 10% gives a share price of 700 euro. Let's have a look at the last example. A company expects a rapid growth of activities over the next 4 years. Yeah, so this is last year, this is year 1 until year 4 with the earnings per share. To finance this growth, the payout ratio for year 1 to year 3 will be 20%. Okay, 20% payout ratio. As from year 4, the payout ratio will be raised to 80%. To settle in a constant dividend growth rate of 5% starting in year 5. So in year 5 onwards, we are going to have a constant dividend growth rate of 5% per year until the infinity. The desired rate of return, also called cost of equity capital, is 12.5%. Question, what is the current value of the stock? So the first thing that we are going to do in order to calculate the stock price is to calculate the size of the dividend for the first 4 years. We have earnings per share, we have the payout rate, so we can actually calculate the size of the dividend for year 1, 2, 3 and 4. Next, we are going to calculate the present value of the first 3 years of dividend payments. And then in the second period, we're going to use the terminal value that captures the dividend in year 4 and beyond, including a growth rate of 5%. So the present value calculations of the first 3 dividend payments is what you can see here. So this is 5, 7.6 and 11.4. Then the terminal value gives you the present value of the dividend payment of year 4 and beyond at T3. So we need to discount that 3 years back as well. In total, the stock price is going to be 617 euro and 78 cents. In this slide, and this is the final slide of this video, you can see that we have on the left-hand side the market value of the business, including excess cash. The market value of the business is also called enterprise value. On the right-hand side, we have market value of equity. That's, of course, the number of outstanding shares times the stock price. And we have used the DDM model extensively to capture the value of the equity. And in a separate video, we're going to talk about the market value of debt. Thank you.